This video is for educational and informational purposes only. Mutual funds and stocks talked in this video are purely used as examples. This video is not meant for advisory or recommendation purpose.
Hello everyone, my name is Swati and you are watching aliceblue YouTube channel. Did you know any action taken by a publicly listed firm impacts its brand name, stockholders or stocks? Well, watch the complete video to understand everything in detail, as we will be talking about what is corporate action, types of corporate actions, how do corporate actions affect the share prices, corporate action life cycle. Now imagine you own a beauty parlor that is very popular in your neighborhood. Due to your services, your parlor owns a distinctive or unique identity in your locality. And even amongst clients who live in distant places do tend to visit your parlor. Now let's say you happen to replace your staff or even change the name of your parlor or change the offers you were offering to your customers. Will it not impact your parlor or your existing clients? It surely will. Corporate action is something similar to this. A corporate action is an event carried out by a company, usually by its management. It has a substantial impact on the company and its shareholders. So what does corporate action mean? When a publicly traded company issues any action that affects its brand name, shareholders and stocks, it is called corporate action. So how does this help you? Well, these actions will help you know a lot about the company's financial health and determine whether to buy or sell a specific stock of the company. Whenever companies plan to come up with any corporate action, it instantly affects the price of their stocks, by which you can determine whether to sell or buy a stock of the company. The only objective of companies to carry out corporate actions is to increase their profitability and create better opportunities for their shareholders. Now that we know what a corporate action is, let us discuss the types of corporate actions that significantly impact stock prices. So there are three main types of corporate actions: mandatory with choices, and voluntary. Mandatory corporate actions are enacted by the board of directors to bring significant changes to the company. The objective here is to improve from the previous year's performance to that of current. In mandatory corporate actions, the shareholders don't have much to do. They simply have to follow whatever the management decides. The mandatory corporate actions are dividends, spin-offs, stock splits, mergers and acquisitions. Dividends. A dividend is a payment made by publicly traded companies to their shareholders from their surplus earnings. They distribute their profit to the shareholders at the end of the financial year. Not only profit, even if companies incur a loss in a particular year, some companies still give off dividends in the form of cash, shares and currency equivalents if they have a healthy cash reserve. The decision to pay dividends lies in the hands of the management. The company directs meets at the annual general meeting, that is AGM, to decide whether or not to pay a dividend. A point to be noted here is that a company can also choose not to pay dividends every year if their policy does not state so. So dividends can also fall under the category of mandatory with choices. Spin-offs. Spin-off corporate action is an operational strategy where a company creates a secondary entity from its parent company. In exchange for a certain amount, the new company acquires assets, employees or existing product lines and technologies from the parent company. The new company that is formed from the parent company is expected to be more valuable. Once the separate entity is created, it is introduced to the market with a new brand name. Next up, we have stock splits. Stock split is a corporate action where a company issues a certain number of shares to its existing shareholders. The splitting is done by dividing one share into more shares. Now let's understand the same with an example. Now assume Priya owns 200 shares of a company at ₹10 each, and the company announces a stock split of 1:2 ratio. Now Priya's 200 shares will be split into two parts, that is 400 shares, and the price of each share will be ₹5 after the split. The calculation will be somewhat like this, Before the stock split, ₹10 into 200 shares is equals to ₹2,000. After the stock split, the price of each shares will become ₹5. So the market price of the shares will be ₹5 into 400 shares, which equals to ₹2,000. Though the number of shares increases, the overall value of the investment remains still the same. and the stocks can be split at the ratio of 1:4, 1:2 and 1:10. Basically, it depends on the requirements. When the stock price rises beyond the standard level and shareholders become uncomfortable with the rising price, the stocks are split. This increases the liquidity of the stocks. Mergers and acquisitions. Here, when two companies believe that joining hands together can make them more successful and survive in the bigger market, they merge. Basically, a new entity is formed with the assets and operations of both the companies. Whatever shares both the companies had separately before the merger now will be given to the new entity after the companies have become one single unit. On the other hand, when a company completely takes over the assets and liabilities of another company, it is called an acquisition. Now we have mandatory with choices. These are corporate actions when the management gives several options to the shareholders to choose from. Out of the several options, one will be a default option. Before the company takes any action, the shareholders vote on it. They might also choose not to vote. So if they don't vote, the default option will be considered and the shareholders will have to follow that. Now let's take the example of dividends. A company can offer dividends in the form of stocks or cash dividends. Out of these options, one can be the default option. Now let's say the stocks are the default option. So if the shareholders haven't voted or if they have not voiced their particular choice, they have to accept the stocks as dividends. Voluntary. In the voluntary corporate action types, the shareholders tend to be a part of the decision-making process. This means the shareholders need to participate in certain decisions to ensure the smooth functioning of the company. But before making any decision, each shareholder has to submit their opinion stating if they want to participate or not. Just like in a tender offer, a shareholder might buy all the shares of the company. It's their choice. Now, you must be wondering, what is a tender offer? Typically, when an investor proposes to buy shares from every shareholder of a publicly traded company for a specific price at a specific time, this is known as a tender offer. The investor offers a higher price per share than the company's stock price, giving shareholders more incentive to sell their shares. This is a pure example of voluntary corporate action. So how do corporate actions affect the share prices? As I mentioned earlier, corporate actions significantly impact stock prices. Corporate actions portray the intention of the company towards its shareholders. The reputation and recognition of the company depends on the types of corporate actions the company carries out. Other than dividends, stock splits, and mergers and acquisitions, there are other examples where corporate actions significantly impact stock prices. They are bonus shares, rights issue, buyback of shares. Bonus shares. This is a corporate action where a company gives shares to its existing shareholders for free of cost. The primary reason for giving out bonus shares is to improve a company's brand recognition and to reward its shareholders. The bonus shares are usually given off in the form of 2:1, 3:1, 5:1 and etc. For example, if you own 100 shares of a company worth rupees 10 per share and the company announces bonus shares at a 3:1 ratio, this means for one share, the company will give you 3 more shares for free of cost. After this, you must be wondering when the bonus shares will be distributed. To be eligible for a bonus share, you need to buy the shares at least one day before the ex-date. If you are eligible for bonus shares, it usually takes 15 days from the record date for the shares to be credited to your Demat account. Now, you must be thinking what ex-date or record date and bonus issue is. To understand this concept in detail, do check out this video. That is, what is bonus share, where you will get answers to all your questions or doubts. Rights issue. When companies want to increase their share capital by offering shares at a discounted price to its shareholders, then the right issue is implemented. It is an invitation to current shareholders to purchase additional shares in the company. But the shareholders need not necessarily participate in the rights issue. They will only subscribe to this rights issue if they are convinced of the company's future success. The stock price of the company issuing rights shares is adjusted just after the record date. which is a cutoff date set by the company. Shareholders have the option of subscribing to the rights issue in part or in full, or they can even decline the offer of purchasing additional shares. Not only this, but they can also transfer their rights to other people. The entire process of transferring rights issues to other people is called the renunciation of rights issue. Lastly, buyback of shares. This is an action where a company circulates its shares within itself. In simple words, it is a method where a company invests in itself by buying shares from its investors. But why? Well, this helps the company to restore confidence in itself, prevent other companies to acquire it, and improve the profitability of each share. Corporate action life cycle. In the corporate action life cycle, we are going to see the entire process of the corporate action performed by the corporate action setup team. We will learn about the crucial players or participants involved to carry out a specific corporate action and what are the roles of each participant in the entire process. The first player is the one who announces the corporate event to the market. The second player is the registrar and the custodian who is in the processing stage for the preparation of the event. Mind you, the registrar is a very important player in a company who communicates within the custodian and the custodian further communicates with the brokers. The custodian then further informs the investment banks regarding the decided corporate event. They give intricate details of the event like the tax benefits, the positions, the holdings of stocks, their entitlement rights, settlement dates, etc. Then comes the role of the team in itself. That is the corporate actions processing team. This team will validate the happening of the event by sending message across. And the last step is the payment. On the payday, the entitlements will be credited to the accounts of the shareholders. I hope that you are clear about the topic. Thank you so much for watching this video and I will see you in the next one. Until then, bye-bye.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.